everyone. So last presentation of the day. Thanks for hanging in there. And so we're going to talk a little bit about driving innovation and digital transformation. So firstly, just a little bit on how do we get here? How do we get to this new word, which is embedded finance? What does it mean? And how do you implement it? And then a couple of use cases where there are direct-to-consumers or B2B payments. So if you think about the evolution of fintech in general, let's say that we start with the banks. So they've been around for 250 years, even more than that, right? And they started in the 70s, of course, with the advent of computing, really creating their own legacy systems. And that went along for a long way, and they still exist in the banks. And then you start coming into, on the infrastructural side, companies like Oracle or FIS, Fiserv, a number of companies started supporting them from the infrastructural side so that they could modernize their systems. And of course, one of the leading companies that arose from that openness to access of banking is PayPal in '98. Then you fast forward another 10 years, and the infrastructure evolved in such a way that now you have tools to manage fraud and compliance and security, and payments are really open to the world. And then you start having companies like Stripe that come by, really streamlining SMB payments, making it easy to perform e-commerce online. Fast forward, and you start getting companies like Revolut. So Revolut, of course, new bank, widely successful, and they are a direct-to-consumer brand, and they could only build everything that they have because they're not a card issuance processor, they're not a payment processor. They do need to provide all these services in order to go direct-to-consumer. So the infrastructure kept evolving, and then you have the direct-to-consumer brands. Of course, many others could be mentioned there, such as Monzo, for example. And now, where we are today, starting more or less 2021, is this concept of embedded finance. And the main concept there is that you don't have to be a regulated financial institution in order to provide financial services to your clients, whether it's credit cards or debit cards, bank accounts. And that's where the embedded finance offering starts, by providing all these services in one platform, regulated. So talking about regulation, that when it's financial services and you talk about this subject, software is only a piece of it. You have to be compliant with the existing regulation. So what is the challenge that regulators have worldwide? Well, first, of course, they need to protect the economies from money laundering, corruption, finance activity, consumer identity, data protection, financial protection, essentially to make sure that things like 2008 don't happen again. At the same time, of course, they can't stop economic growth. It will create jobs, it will create financial inclusion, provide better services to the end consumers and the companies, and really help evolve the economy in such a way that people will be served better. Now, what's the way to do it? In our mind, and in the regulator's mind, there's only one way, which is regulating the fintechs. So it's not only, when we saw in the previous slide those infrastructural companies, they were really about streamlining, optimizing, and providing software that will allow other companies to build on top. But now, if you want to provide embedded finance, you really need to create regulation, and most importantly, create accountability of all the stakeholders. So there are sort of two currents in embedded finance. One is the fully regulated approach, which we believe in, and the other one is you are the middle layer, software middle layer, between the regulated institution, whether that's a bank or another financial institution, and then you provide a software layer for others to implement. That means that you have no accountability, ultimately, from the regulatory standpoint. So for the enterprise is the one to do that, it's all about confidence. Telcos, whether you're a telco or in healthcare, insurance, retailers, One thing you already have is your own regulators. You don't need the financial regulators. You need to be step away from that, but you obviously have your own reputation to uphold. So let's say you're a retailer, you launch a card to market, and there's a data breach, for example. You do not want to be in a situation where your brand is associated to that. So what does it take? Well, it's very complicated. So if you are providing these financial services, you need to make sure that all of these things, from executing payments to validating identities, to provide credit, you need to have processes to know your customers, you need to take care of fraud, you need to take care of compliance, you need to have regulatory obligations and reports, you have to report to your bank, to your regulator. So it's very complicated, and this is what embedded finance does. It simplifies it for the enterprises. So if there's a company, let's take a retailer example again, what they want to focus on is commercializing and providing these financial services to their clients with one single integration point, not only from the technological standpoint, but also from the operational standpoint. If you want to provide financial services and you are not in financial service, you don't want to build a compliance team, you don't want to build a fraud team, you don't want to be operating payments, you just want to provide those to your clients. So I'm going to talk a little bit about two sort of use cases of how this could be applied in practice. So one is, of course, a direct-to-consumer new bank. So think of Revolut, like we saw in the previous slide. So your brand is providing directly to consumer e-money accounts, debit cards, credit cards, providing bank transactions, money, domestic and global money transfer, financial wellness, credit, integrating to core business offerings. So the difference between a brand providing this and the new bank and market is that the business model of a new bank and market is very challenging because there are high customer acquisition costs and they need to build brand credibility. If you are already a household brand, say you're a telco, for example, you already have all these clients. From their perspective, the client's perspective, they are banking with Vodafone, with Orange, for example, with taking the telco example. And that really makes the difference. They have a captive audience. And the reason why the business case works a lot better for these brands is, A, they already have the acquisition channels, and two, they have the ability to cross-sell into their mainline business. Meaning, if the unit economics is complicated from the pure financial services standpoint, we know consumers don't want to pay anything. If you are a client of a new bank, you want no fees, you want all the perks, you want all the advantages, you really are not willing to pay anything. So for a brand like this, driving loyalty into their brand means a lot. So reducing churn by 0.2% could mean hundreds of millions of euros. So if you look about how this works for them, how do they implement it? Well, they want all the services that consumers expect to have in these systems, whether it's connection to the banking systems, getting a true bank account, looks like a bank account, and also everything that I need to do on the funds out. I want to transfer to banks, I want to pay my bills, I want to have a card that I can use internationally. I want to be able to go to an ATM. I want to be able to pay at a merchant. I want to send money internationally. So what does that mean for the company that is integrating into an embedded finance platform? Well, they essentially only need to create that user interface. Connect to one single API, which will handle all the complexities from onboarding a customer to everything that has to do with regulatory compliance. And really, with that API and the service provided by embedded finance companies, they will have the ability to provide e-money accounts, which essentially look and feel like a bank account. They have an IBAN, so they can be used anywhere. And then everything really under a safeguarded pooled account, which is what the piece that regulators mostly are concerned with. Is the money there? Are all those accounts solvent? And that's a piece of what the regulation does. Now, if you think about B2B, it's slightly different, their needs. So essentially, you want to build an ecosystem of payments. Meaning, let's take an example, you're a franchise, for example, and you have all these franchisees, thousands of storefronts that you have to serve, right? And these have order management processes, and there are all these transactions that are happening from the franchise to the franchisees constantly. They're providers, they're vendors, and they have other types of necessities, such as they want bulk payments, they want recurring payments. And also, what these brands want is to drive loyalty to their end consumers. So let's say, again, the franchise example, you can provide branded debit cards, credit cards, prepaid cards that will provide things like cashbacks and perks in the store. So that will drive more revenue and loyalty from customers. You also want those franchisees to have streamlined payments, meaning that a customer can swipe a card, for example. So, and the most important thing is ultimately all these systems today are not integrated into the enterprise-wide systems. So if you think about today, in that example, you have 10,000 franchisees, they have their own bank accounts, they bank with their own banks, they might be different banks, they have their own relationships, payments, and what they need to do is constantly do transfers and to pay, whether it's to the larger franchise or to their own vendors. And that is all done in separate bank accounts, which creates obviously more fees, delays, settlement times. So when you think about how you solve that with embedded finance, think about an entire ecosystem of accounts where all these business accounts are transferring money in something akin to P2P. P2P has no costs. Ultimately, everything is sitting within the same ecosystem, and you're really doing ledger movements between all of these accounts, and the costs just go away. Some of our clients were talking about 60% reduction on their entire banking transaction costs, while providing, of course, all the things that they need, whether it's to bill payment, to create their own loyalty cards, and most importantly, the open banking. Open banking is really solving a piece of the integration between systems, but not all of it. So now if you have an order management system, let's say that you are buying goods from your franchise, and that order management system would record the order, there will be a logistics, supply chain, but then the payment's not integrated. You would have to go to your web banking and perform that payment. This would mean an entire integration between all of your enterprise systems, whether you're serving your end customers, you're doing billing, you're doing order management, everything through the same embedded finance API is possible, and now the entire system is streamlined. So this is what we do at Alviere. We really enable enterprise worldwide to offer financial products to their customers, partners, employees. And we believe that this is the only model that actually works because of that centerpiece over there where you have to make business, do business with a financial institution. So we believe in fully regulated financial institutions. In our case, we're already licensed and in the process of licensing in different geographies. And obviously, it needs to be holistic, meaning the client should not have to go build different contracts, different partnerships with other institutions, but rather with one contract, one integration point, be able to provide those services to all their customers. And then, of course, the business models of embedded finance is also very different, because the success only exists for the client and for the embedded finance company if the volume is there, if the clients adopt, if there are enough transactions to make that business model profitable. So it's very different from, say, a SaaS provider, where you will make your money off platform fees or on a user base. You would have seats, and with that's where you make your money. Embedded finance is about success, is a joint activity between the client and the provider of embedded finance. So, of course, all the embedded finance platforms need to provide that base. We're talking about compliance, KYC, know your customer, know your business, automated as a base for everything and all the services that are provided on top of it, including the operational support, and supported by a ledger that is fully auditable by the regulators and by the banks and by our clients in order to be able to reconcile. And all of that supported, on the technological base that allows clients to integrate, and in a modular fashion. So that was it, and we are at the floor, so we invite you to join us there. And if there are any questions, I think we have like 3 minutes. Happy to answer. It is not expensive at all. And the reason why it's not expensive is that that's the model of the shared revenue. Because essentially, the clients, the purpose is that the clients actually don't pay. Meaning, in an invoice, you will have debits, say it's the platform fees, your costs of transactions, and then you will have credits, which are your revenue streams. Ultimately, and over time, the model works as you have more credits and debits. So we actually cut a check to our clients. There's different business models are different on the B2C side. For example, things like interchange rev share on the cards that merchants ultimately pay to the networks, essentially with some volume that will generate revenue. Merchant acquiring services. So by reselling those services, let's take the franchisee example again. So they would have a today with their bank, they say, okay, I want payments. Give me a terminal. They'll give them a terminal. Great, you can swipe a card and you're paying that bank. Now the enterprise will say, you are my franchisee, here's a terminal for you to pay, right? And there are margins on those payments. Ultimately, the purpose of these systems is that it's a revenue stream, not a cost.
So you use the same, sorry,
Go ahead.
is it the same platform in each geography? The regulators are quite different in the US than in Europe.
Mm-hmm.
So you use the same, is it the same instance of the technology?
Yeah. So the question is it the same instance of the technology? The base technology, yes. But like you just mentioned, different regulations have different demands. So for example, in the EU, there's a big concern around safeguard account reconciliation. In the US, for example, that does not exist. So it exists, obviously reconciliation needs to exist, but not in the same manner as in the EU, which is daily and reportable and auditable, right? So the base platform is the same, but different providers in different regions may apply. For example, identity management in the United States could be going directly to public records to identify social security numbers. In the EU, it's going to be different. Mainly, it's documental verification, meaning the picture of the passport and the selfie. So the base platform is exactly the same. The infrastructure is different because of, for example, EU regulations. It has to be in the EU soil. for example. So we don't commingle data, but the base platform is the same. And what we do in our case is that the API is only one. Those complexities are completely abstracted from the customers integrated into it. Yes.
I've had some experience in this, and in my experience, very often the people that want to do these kinds of integration for embedding are people that somehow have difficulties getting payment solutions in more in more regular ways. Have you had any experience around that?
Yes.
Riskier customers that are using these than using the more common?
Yes, I think that that's really the job of embedded finance companies, is to really simplify that, right? So I always use the example, our card issuance processor has 150 API endpoints. If we're going technology, for us it's one, create card. That's it, right? So it's about, we understand that our clients do not have the knowledge. They are not financial institutions. So generally they don't have a knowledge. So yes, there's an educational process for them to get their minds around what they are doing. So it's our job from the client support and project implementation side to really help them through that journey and simplify it to the most their integration, right? And the difference between of course, you know, if you would want to do payments and you would go to a Stripe or an Adyen or a Braintree or all those payment providers and doing it from the embedded finance standpoint, is that it's holistic, meaning you will have all those different products in one single sort of relationship, one-stop shop approach. While to do something specifically with those companies, then you will have the 150 endpoints, right? And you will have to learn and understand all the different complexities of, for example, processing a payment on the acquiring side, right? And so our job, in a way, is to simplify that, make it easy for companies to adopt, knowing that they are not experts on it. So that's one of the very clear challenges that embedded finance companies have.
Maybe I didn't ask the question well enough. I can give some examples. How about if there is a chain of casinos that approaches you and wants to have embedded finance in their systems, or a crypto NFT exchange?
Okay, so I understand now.
Service where they can sell financial services to their customers.
So you mentioned two highly complicated areas that have a lot of attention, of course, gambling and crypto, with everything that is going on with crypto. Of course, there are certain business models that are a lot harder to support, and some of them are just not possible, because ultimately the difference between EMIs or money transmitters in the United States, for example, is that there is an underlying bank. The funds do exist in an underlying bank. The bank works with us because we are regulated, but they also put some guardrails around it. And I would say that what we see a lot in the market is some banks are more specialized in those types of services, right? They have worked with their regulators in such a way that they are sort of authorized to work with those. That's also one of the big advantages of embedded finance at the end of the day, is that we, as a company, now I'm talking about Alviere, right? We can work with different partner banks. Some like some business models, some don't, and some we don't. With that, so sorry for that. But yeah, that's the challenge, is to have multiple partners. So thank you very much, and enjoy the rest of the show.